Hey, welcome back. Business 163, Personal Finance. And we are now in video number 5 in this module 8. And as you already know, we're talking about in this video, mortgage loans. Yeah, another type of credit or debt. For many people, the largest debt they will ever personally take on, the mortgage loan. So let's jump right in. What exactly is a mortgage loan? Mortgage loan essentially is a home loan. And in the United States, unless you're going to pay all cash for a home, you're going to need a mortgage. A mortgage lender pays the home seller the balance between your down payment and the final sales price. So typically, for instance, if you're buying a home for $600,000 and you're putting 10% down, that would be $60,000. That means there's still a difference of $540,000 between your down payment and the purchase price, 90% of that sales price, and that's what the mortgage loan is. It is the loan that the lender pays to the seller to complete the sale of the home, and now you owe the lender $540,000, and they take as collateral, remember that term from the very first video, right? The asset that you pledge as security, and that would be, of course, the home you're living in, the home you buy, the home that you sort of own, except for most of it's owned by the mortgage lender that you're slowly paying them back, right? In the United States these days, typically home buyers put down anywhere between 5% and 20% down, and they finance the rest. This means that a typical mortgage loan these days are for between 95% or 80% of the purchase price. Now, you can put down as much as you want if you have those funds available. If you want to put 50% down and you've got, well, $250,000, $300,000 in cash to put down, they'll let you do that. Your loan will go through quite swimmingly with a very large down payment, but most folks don't have that kind of money. And so by saving and scraping together a down payment means pretty large mortgage loans for many Americans. How are loan applications approved? Generally speaking, there are 4 criteria every mortgage lender uses. Doesn't really matter what type of loan product, doesn't matter whether it's a fixed rate loan, adjustable rate loan, a 30-year loan, a 15-year loan. Every mortgage lender is going to consider the 4 same general criteria. Number 1, income. Income to repay the loan. What is your employment history? What is your employment stability? Where do you work? How much do you make? Do you make enough to make the mortgage payment? Generally speaking, a mortgage lender wants to see that the total monthly payment, and that includes principal, interest, taxes, and insurance, your total monthly outgo for this mortgage is about 30% of your take-home pay. So think about your income, think about a third of that, and that's what a mortgage lender would like to see approximately as the mortgage payment that you're applying for. The second criteria is the loan-to-value ratio. In other words, how much down payment are you putting in, which is known as your equity, right? The down payment is your money, and therefore, how much is the loan as a percentage of the value of the home? Now, let's just do some simple math. If you put down, let's say you're buying a home for $500,000. If you put 5% down, that means the loan-to-value ratio is 95%. 95% of its loan to the value of the home, right? Versus if you're buying a $500,000 home and you put down 50%, you put $250,000 down, that means your loan is only $250,000. That means the loan-to-value ratio is 50%. Now here's really the thing for you to take away from this discussion about loan-to-value ratio, or as we call it in the industry, the LTV. The thing to notice is that if you put 5% down and you now owe 95% of the value of the home, what happens if you're a married couple, you both lose your jobs, one of you ends up in the hospital, and things go really bad? Chances are with only a 5% down payment, eventually you may start thinking about walking away from the house, letting the house go into foreclosure. Now, think about this instead. What if you put down 50%? You put down $250,000 on the house. Quite frankly, if things go bad, you are much less likely to walk away from the house than you are if you only put 5% down. I hope you understand in concept what we're saying. We're basically saying that a lower loan-to-value ratio is a much safer loan for a lender to make, and that's one of the considerations in approving a loan application. If you're only putting 5% down, a lender wants to see everything absolutely squeaky clean. If you're putting a much larger down payment down, a lender will be a little more lenient in considering the other aspects, the other criteria that is used to approve a loan. All right, let's keep moving. Criteria number 3 is credit, your credit history, right? Remember, if it's true that your past treatment of debt is the best predictor of how you'll treat future debt, obviously a mortgage lender is going to be very interested how you've treated previous debt, since you're now contemplating perhaps the largest loan you've ever contemplated in your life, right? All right. 4th criteria is collateral. If the lender is going to be taking the home itself as collateral to secure the loan, well, the lender wants to make sure that the home is in decent condition, that the home is at least worth what the sales price is, right? And those kinds of things. And that's why why a mortgage appraisal is performed by a licensed appraiser, licensed and certified by the state of California, to certify with an appraisal report that the house is worth the value you're paying for it. Well, generally speaking, those are the 4 criteria every lender uses to assess a mortgage loan application. All right. Now, what are the downsides of buying a house with a mortgage? Well, typically mortgage loans are pretty large, and so the only way that any household can afford the monthly payment is by making it for a very long term. The longer the term, the lower the monthly payment. And so typically mortgage loans are 30 years long. That's a long time. And quite frankly, a lot can change in our lives in 30 years, right? I mean, just look at your own life, however long, how long you've been alive, how old you are, right? Has a lot changed in your life over your lifetime? Yeah. Well, typically a lot changes in people's lives over 30 years, right? And as we said before, we can't predict the future. Also realize during the entire time you own that home, you're responsible for the care and maintenance of that home, right? You can't call the landlord. You just got to get up in the morning, look in the mirror. You're the person responsible for calling a contractor or repairing the house, right? And quite frankly, there's never a 100% guarantee that your home will increase in value, right? And so many times folks are sort of counting on the home to increase and appreciate in value, and sometimes that's not always the case, right? Also, one of the other downsides of some mortgages, well, quite frankly, some loan products have loan payments that increase over time. Many of us have heard of a product called the adjustable rate mortgage. Those the interest rate on that loan will adjust. It will change periodically, maybe once a year, maybe at the end of a prescribed period of time. And depending what happens when the interest rates change, you could be looking at a substantially higher mortgage payment than what you'd grown used to, right? Which means, of course, well, that suggests you got to be really careful about the type of loan product you select to finance your home. That sort of goes without saying, right? It's a lesson that many of us have learned sort of the hard way. But there are downsides to a mortgage, as you see right here, right? What are the upsides to a mortgage? Well, quite frankly, you will own a home. Yes, you own a home. That's typically the way that most homeowners get started in the United States, by taking out a loan, putting a down payment, taking out a loan, buying their first home. Many, if not most, homes in the United States do appreciate in value over time, especially if you look at it over the long haul. Many homes appreciate over time. And quite frankly, let's just be perfectly honest. For most Americans, home ownership and the commensurate growth or appreciation of value, that's how households, how families start the beginning of building generational wealth. It really is historically been a key to the average working class family to start building generational wealth that will continue to build to the next generation. This is one of the upsides to home ownership, and one of the only ways to own a home is through a mortgage loan. Now, full disclosure, I am a proponent of the mortgage loan, not only because I worked in the finance industry, in the mortgage industry, for about 10 years of my career. It is one of the most satisfying feelings, being able to help a family purchase their first home where their kids are going to grow up and go to school and all those great things, build memories. And so I am a very strong advocate of home ownership, especially as a way to start building a family's generational wealth. And yet we need to remind you that owning a home is not the only way to build a family. Certainly not, right? And when you take on the responsibility of a mortgage loan, you really are taking upon the responsibility to pay back for decades, every single month, possibly the largest loan you will ever have in your life. That is not something to be done quickly or lightly or capriciously, right? It is something that you need to take very, very seriously. We typically recommend that mortgage loans, you really shouldn't contemplate it until you act like an adult. What I mean by that is simply that you have a handle on managing your personal finances. Well, that's the point of this whole class, right? So thanks so much for this short video, for paying attention to this short little video on mortgage loans. We'll see you in the next video.